If you live with a pre-existing condition and dream of retiring abroad, you've probably heard every version of the same warning: insurance won't cover you. The truth is more nuanced. Some plans exclude, some limit, some conditionally accept, and others will insure you fully with the right underwriting. In this episode, we'll demystify what pre-existing actually means, how insurers evaluate risk, what gets covered and what doesn't, and how to set up a realistic, sustainable healthcare plan outside your home country. If you find this helpful, tap like, subscribe to Travel Choir, and ring the bell so you never miss our Retire Abroad guides. Why pre-existing scares insurers, and how they define it. Pre-existing condition isn't a moral judgment, it's an actuarial term. Insurers are pricing the future by reading the past. Most use one of two lenses. The first is a look-back definition: any diagnosis, symptom, test, prescription, or treatment that occurred within a fixed period, often 60, 90, 180 days, or even 24 months, counts as pre-existing. The second is a stability definition. If your condition has been stable, no new symptoms, no medication changes, no physician-recommended adjustments, for a specified span, it may be treated as if it were not pre-existing. What trips people up is that stability is technical, not casual. A slight dosage increase for blood pressure, a new inhaler for seasonal asthma, or an ER visit you shrugged off can reset the clock. Equally crucial is the difference between emergency and ongoing care. Even generous travel medical policies are designed to rescue you from acute events, not to fund long-term management of chronic diseases. Understanding those two lines, time and intent, explains many of the yes but answers retirees receive when they start shopping. Two roads: travel medical versus international health insurance. Retirees abroad typically face a fork in the road. On one branch is travel medical insurance. It's built for emergencies during trips measured in days or months, not years. It excels at sudden illnesses, injuries, evacuations, and hospitalizations. It is not designed to underwrite your long-term condition management, and when it does touch pre-existing issues, it usually does so through narrow exceptions such as acute onset benefits, with strict age caps, dollar maximums, and multiple exclusions. On the other branch is international private medical insurance, often called expat or global major medical. This behaves more like health insurance back home. It covers inpatient and, often, outpatient care, cancer treatment, imaging, and sometimes prescriptions, maternity, and wellness, depending on the tier you buy. Crucially, IPMI doesn't reflexively exclude pre-existing conditions. Instead, it underwrites them. That means you may be accepted with a higher premium, a permanent exclusion on the specific condition, a waiting period, or a combination of all three. IPMI is the route most retirees ultimately choose if they intend to reside abroad more than half the year, especially when managing an established diagnosis. Underwriting 101, Moratorium, Full Medical and MHD. Underwriting is the gate you must walk through. With moratorium underwriting, you typically don't submit medical records up front. Instead, the insurer declares that any condition for which you had symptoms, treatment, medication, or advice in a defined period before the policy start is excluded initially, but may be covered after you've been symptom-free and treatment-free for a specified continuous period on the policy. This can work well for issues that are genuinely resolved, but it won't magically convert active diabetes or heart disease into a covered benefit. Full medical underwriting is more rigorous. You disclose your health history, medications, physician reports, and sometimes recent labs. The outcome can be a clean acceptance, a rate loading, you pay more, a condition-specific exclusion, a waiting period before coverage activates, or a blend of these. For common, well-controlled conditions like hypertension or hypothyroidism, many retirees are surprised to receive standard terms or modest loadings, especially if their medical file shows stability and adherence. There's also a group construct called Medical History Disregarded, MHD, usually available only through large, sponsored groups or employers. It accepts members without singling out their past conditions. For individual retirees, MHD isn't typical, but it's useful to know the term when evaluating retirement communities or membership associations that negotiate group coverage. Here's the quiet lever you control. Documentation. A tidy health timeline, clinic notes that explicitly state control and stability, and a clear medication history are powerful. Underwriters prefer clarity to guesswork. They reward predictable risk. Before we move on, a quick value tip. If you're feeling overwhelmed, compare options through a reputable marketplace or speak with a licensed international health specialist who can model underwriting outcomes. We've placed helpful resources in the description so you can explore plans side by side without pressure. That's a travel choir recommendation. Use it to save time and avoid blind alleys. The fine print that changes everything. 3 phrases decide outcomes for many retirees. The first is acute onset of a pre-existing condition. Some travel policies will cover a sudden, unexpected flare that requires immediate care, but not a predictable complication or routine prescription refill. Age limits, dollar caps, and exclusions for specific diagnoses often apply. If you rely on this clause, read every word and ask the insurer to confirm, in writing, how it applies to your exact diagnosis and age. The second phrase is waiting period. IPMI plans, particularly those that accept pre-existing conditions, may require you to wait months before certain benefits become active. This is common for cancer, cardiac, and musculoskeletal conditions. If surgery is on the horizon, timing your enrollment is as strategic as choosing the plan itself. The third is chronic versus curable. Many policies treat chronic conditions, diabetes, COPD, heart failure, differently from curable illnesses. Emergency stabilizations may be covered, but long-run management might not be, or it may be capped at a lower outpatient limit. Prescription benefits are their own world. Some plans include them richly, others barely. Add 2 border topics if you're a North American retiree. In the United States, Medicare generally doesn't travel well. Supplemental plans vary widely. In Canada, provincial health plans have strict out-of-country limits and requalification rules when you return. Neither system is a substitute for robust coverage abroad. If you plan to move, think of your destination policy as primary insurance, not a backup. What it really costs, and how to control it. Cost is a function of age, geography, benefits, and underwriting. Premiums rise with age, and they jump when you add outpatient, dental, or maternity. They also vary by region. A plan priced modestly in Southeast Asia can cost significantly more for coverage in the United States due to provider charges. Many retirees contain costs by excluding the U.S. from the coverage region or choosing a deductible that fits their emergency fund. Another lever is tiering. You can buy inpatient only to handle the big shocks, then pay cash for routine clinic visits in countries where a specialist consultation costs less than dinner back home. Underwriting can nudge price and scope. A small loading for a well-controlled condition may be cheaper and more reliable than gambling on exclusions. Conversely, if your condition is the budget buster, accept a narrowly tailored exclusion while securing rich benefits for everything else. The aim is not perfection. It's to neutralize the financial event most likely to derail your retirement. Build a care budget the way you build a housing budget, premiums first, then an annual cash reserve for outpatient visits, labs and prescriptions, plus a contingency fund for one medium-size event. When you know your numbers, "Can I afford this?" becomes, "I've already prepared for this." Getting approved and getting paid. The application is your biography in medical form. Accuracy wins. List every medication by name and dosage, even if it feels minor. Note dates of diagnoses, last imaging, and recent follow-ups. Ask your physician to include the magic sentence in clinic notes. Condition is stable and well controlled. No change in medication recommended. That sentence often prevents a stability clock from resetting. If you recently had a change, explain why, and show resolution. Underwriters are human. Coherent narratives reduce uncertainty, and uncertainty is what they price. Once approved, create a claims playbook. Save PDF copies of your policy schedule, benefits table, and exclusions on your phone. Add your insurer's pre-authorization contact and local assistance number to your favorites. In an emergency, the fastest recovery is clinical and administrative. Present your coverage letter, request direct billing where available, and document every step: reports, invoices, prescriptions. After discharge, submit clean, complete packets. Many denials are paperwork denials, not coverage denials. If an appeal is warranted, keep it technical and organized, not emotional. You're speaking to a clinician and an adjuster across a desk, not arguing on the internet. A final tip on networks. Ask how the plan pays outside the network. Can they guarantee payment to a private hospital in your city? Will you need to pay and claim? Is there a country-specific partner they prefer? Knowing this before you get sick is the difference between a coordinated admission and a frantic credit card juggle. Making your decision, a practical framework. Imagine a simple triangle. One corner is medical reality, your diagnoses, medications, and the last 2 years of care. The second is lifestyle reality, where you'll live, how often you'll travel, whether you need coverage in multiple regions. The third is financial reality, the premium you can sustain for 10 years, not just for the first year. Put travel medical in the frame if your stays are seasonal and you rely on emergency-only coverage with a strong, acute onset clause. Put IPMI in the frame if you're relocating, need outpatient benefits, or want predictable access to private hospitals. Now sketch a scenario. You move to Lisbon, Chiang Mai, or Merida. In year 2 you need a cardiology workup. Does your plan let you book a specialist next week without a reimbursement fight? If the answer is yes, you chose well. If the answer is maybe, after pre-auth and a pile of receipts, that might be fine, if you planned for it. The win is alignment, not fantasy. As you evaluate, remember the order of operations. Pick a coverage region that matches your real life. Choose benefits that neutralize your biggest financial risks. Accept that a known condition may carry a loading or an exclusion, and decide in advance which trade-off you prefer. Then, assemble your paperwork, request quotes, and have a licensed international advisor reality check the terms. Pre-existing conditions don't end the dream of retiring abroad. They refine it. The path forward is clarity. Know your definitions. Choose the right product family. Cooperate with underwriting and finance the care journey you'll actually live, not the one you hope to avoid. For curated tools that help you compare international plans and find travel medical options with strong emergency features, check the resources in the description. That's our straightforward recommendation. Use vetted marketplaces and direct providers to match your health profile with the right coverage. Links are waiting for you below. If this episode helped you, please like the video, subscribe to Travel Choir, and share it with someone who's planning their move. For more deep dives on visas, healthcare, budgets, and lifestyles that actually work, explore our full playlist. I'm cheering for you, and for a retirement that's healthy, sustainable, and beautifully lived abroad.